Most retirees think the biggest risk is a market crash. But here's what I've learned after watching thousands of retirement decisions. The crash isn't what costs you money. It's the first 24 hours after the crash. That's when three reflexes kick in that can cost the average retiree $50,000 or more over their lifetime. This is a fan-made educational episode. Some narration may be AI-generated and is not the real voice or statements of any individual. Here's what most people believe about market crashes. They think preparation means having the right asset allocation, maybe some cash on the side, and a plan to ride it out. The financial calculators tell you to stay calm, don't panic, stick to your strategy. All true advice, but completely useless in the first 24 hours when your brain is flooded with stress hormones and your retirement account is down $200,000. The real problem isn't the market drop. It's what happens in your brain during those first critical hours. Your nervous system triggers three costly reflexes that bypass all rational planning. The sell reflex to stop the bleeding, the buy reflex to catch the falling knife, and the freeze reflex where you do nothing while headlines make your decisions for you. I've seen retirees lose more money in 24 hours of poor decisions than they lost in the actual crash. A 67-year-old couple I know sold everything when the market was down 30%, then bought back in 6 months later when it had recovered 25%. They locked in a permanent 20% loss. That's $160,000 on an $800,000 portfolio, all because they didn't have rules for the first 24 hours. Here are the 5 golden rules that protect you when the market shocks your system. Never make any portfolio changes in the first 48 hours of a market shock. Period. Your brain needs time to process what's happening without the stress response taking over. Write this down and put it somewhere visible. I will not buy, sell, or transfer anything for 48 hours after a market drop of 10% or more. Why this matters? Stress hormones peak in the first 48 hours. Cortisol and adrenaline make you focus on immediate threats, not long-term consequences. A retiree who waits 48 hours is 3 times more likely to make a rational decision than someone who acts immediately. Here's how to implement it. Set a portfolio alert for any single day drop of 5% or more. When it triggers, your only job is to wait. Don't check your accounts, don't read financial news. Don't call your advisor in a panic, just wait. The markets will be there in 48 hours. Your money will be there, but your stress response will have calmed down. Before any market event, know exactly how much cash you need for the next 12 months, not 6 months, not 18 months, exactly 12 months. If you have that covered outside your investment accounts, you can afford to wait out most market recoveries. Here's the math. If you need $60,000 per year to live on, you need $60,000 in safe, accessible cash, not invested cash, not money market funds tied to your brokerage account, real cash in a savings account that you can access without selling anything. The mistake most retirees make is having only 3 to 6 months of expenses in cash. When the market drops, they panic because they might need to sell at a loss to pay bills. With 12 months covered, you have time. Time is the most valuable asset in a market crash. If you're going to buy during a crash, never invest more than 5% of your total portfolio value in any single purchase, and never invest more than 15% of your total portfolio in the first 30 days after a crash. Here's why this works. Markets don't drop once and recover. They drop, bounce, drop again, bounce again. If you put 20% of your money to work in the first drop, you have nothing left for the second drop, when prices might be even better. Example, your portfolio is worth $500,000 before the crash. It drops to $350,000. You can invest a maximum of $7,500 on day 1, 5% of your original $500,000, and no more than $75,000 total in the first month. This forces you to spread your purchases over time and gives you multiple chances to buy at different price levels. For the first 7 days after a major market drop, limit yourself to 1 10-minute news check per day. Set a timer. Read only factual market data, not opinion pieces or predictions about what comes next. The problem with financial news during a crash is that it's designed to grab attention, not inform decisions. Headlines like, "Is this the next Great Depression?" or "5 stocks to buy in the crash" trigger emotional responses that override your planning. Instead, check only these 3 data points once per day: the S&P 500 closing price, the 10-year Treasury yield, and the VIX volatility index. That's it. No articles, no expert opinions, no social media posts about the market, just the numbers. Within the first 24 hours, set a specific date, 30 days in the future, to review and potentially adjust your strategy. Write it on your calendar. Until that date, no changes unless you're following the position sizing rules from Rule 3. This does 2 things. It gives your brain permission to stop obsessing over daily market moves, and it ensures you don't ignore the situation forever. You're not abandoning your portfolio. You're giving yourself time to make good decisions instead of fast decisions. On your review date, look at 3 things: how your portfolio has recovered, whether your income needs have changed, and whether any of your original assumptions about risk tolerance were wrong. Only then make adjustments. Now let me tell you about the 3 most expensive mistakes I see retirees make in the first 24 hours. First mistake, selling to stop the bleeding without a rule. A 72-year-old man sold his entire stock portfolio when it dropped 25% in March 2020. His reasoning: "I can't afford to lose any more." But he had no rule for when to buy back in. The market recovered to new highs within 5 months. He missed the entire recovery and turned a temporary loss into a permanent one. Second mistake, buying immediately without checking liquidity and time horizon. A 65-year-old woman saw her favorite dividend stocks down 40% and used her emergency fund to buy more. But she needed that money for a roof repair 3 months later and had to sell at a loss. Never invest money you might need in the next 12 months, even if it looks like a great opportunity. Third mistake, freezing and letting headlines decide for you. A couple stopped making any decisions and just watched the news all day. They didn't sell, but they also didn't rebalance when their bond allocation grew too large as stocks fell. 6 months later, they were underweight stocks just as the recovery began. Paralysis is still a decision and usually the wrong one. Here's your action checklist for the next market shock. First, check your liquidity and calculate exactly how much cash you need for the next 12 months. Move that money to a high-yield savings account today, before any crisis hits. Second, write down your do-nothing rule. What market drop percentage will trigger your 48-hour waiting period? I recommend 10% for most retirees, but choose your number and write it down. Third, set position, sizing limits for any crisis purchases. Remember, no more than 5% of your total portfolio value in any single purchase, and no more than 15% total in the first 30 days. Fourth, set rebalance thresholds based on percentage drift, not calendar dates. For example, rebalance when any asset class is more than 10% away from your target allocation. Fifth, create your news diet plan. Choose one reliable financial news source and set a specific time each day to check it. Outside that window, no financial news. Finally, write down your next review date, not soon or when things calm down. A specific date on your calendar, no more than 30 days away. Here's what you need to remember about surviving market shocks. The crash doesn't cost you money in the long run. Markets always recover eventually. What costs you money is reacting emotionally in the first 24 hours when your stress response is running the show. Your retirement portfolio can survive a 50% market drop. History proves this. But it might not survive a series of emotional decisions made when you're scared and not thinking clearly. The $50,000 mistake isn't losing money in the crash. It's the permanent wealth destruction that happens when you sell low and buy high, because you didn't have rules for those critical first hours. Remember, this is educational information only and should not be considered personalized investment advice. Always verify current rules and regulations with official sources like SSA.gov and consult with qualified professionals for your specific situation.